This is Nightly Business Report with Bill Griffith and Sue Herrera.
The chips get chipped. Semiconductor stocks fall hard on a surprise warning from a major company as investors wonder whether the market can make new highs.
Losing share. P&G, the world's largest consumer products company, had to lower prices as it struggles to adjust to rising competition.
Alpha male, is too much testosterone what's plaguing the hedge fund industry? Those stories and more tonight on Nightly Business Report for Thursday, April 19th.
And we do bid you good evening, everybody. We saw a classic chip wreck on Wall Street today. Semiconductor stocks pulled the technology sector lower, and that in turn was a big drag on the broader market. It started after Asian chipmaker Taiwan Semiconductor delivered a disappointing revenue forecast. Now, because Taiwan Semi is a big Apple supplier, some interpreted its warning as a prediction of softer smartphone sales. And if that wasn't enough, there was a report that Facebook is designing its own chip and will cut back on its reliance of products from Intel and Qualcomm. Well, the result was a rough day for many of the chip makers. In fact, Intel was the big drag on the Dow today. Kim Forrest is Senior Portfolio Manager at Fort Pitt Capital. She joins us to talk about this. And I know you own many of these companies, but we already knew, Kim, about the slowdown in personal computer sales. There's a big reliance on smartphone sales now, and now we hear about companies wanting to design their own chips. What's going on?
Well, it is a time of change, and that is a time of opportunity. But I think that a lot of the companies that want to design their own chips, I think the investors don't understand that they are not necessarily going to make their own chips, which means run the fabrication plant. If Apple were to make its own chips, it would have had to have the shovels in the ground already and building that fabrication plant. So they're likely going to use either Taiwan Semiconductor or another company, or even Intel, who does third-party chip building for other people. They're going to have to use these services to actually get their chips made. So I think that we're throwing the baby out with the bathwater today.
You've had in the past a slightly overweight position in technology. Did today's news influence you one way or another?
No, not really. We're looking 3 to 5 years in the future, and what we think is there's going to be more semiconductors needed and used in 3 to 5 years than there is today, driven by many uses, including, phones. But I think there will be new devices, but I think things like cars are going to take a whole lot more semiconductors than we can even imagine right now.
Now, I was looking at charts today, and I saw that Intel and Taiwan Semi are both just coming off all-time highs set earlier this year. I know you are a value investor. Are they too expensive for you now, or do you still like them here?
Well, we don't look at Taiwan Semi on a valuation basis, and I think you have to make the call every single day of whether or not you're going to buy Intel. But looking, again, 3 to 5 years from now, we see that demand is going to be higher. So we'd take a look at that if we needed to put money to work.
And do you still find significant value in this market, specifically in technology?
There are pockets. There are overlooked pockets of technology. I think the focus has been on FANG, and that mostly the media aspect of technology. And we have not been looking there for many reasons. But so we've been looking really to the suppliers and the chip stocks, because all of the technology that you're fond of, and even stuff that you don't know that they're inventing right now that you're going to be fond of, it's delivered on chips.
Very good. Kim, always good to see you. Thank you.
Thank you.
Kim Forrest with Fort Pitt Capital joining us tonight.
And Procter & Gamble also had a rough day. Despite reporting better than expected earnings, the Dow component lost market share as competition intensified. Not only did that keep a lid on sales growth, it also pressured the stock, which fell more than 3%, making it the worst performing stock on the Dow today. It's still the world's biggest consumer products maker, but Procter & Gamble, maker of iconic brands like Tide, Bounty, and Gillette, is not immune to a changing marketplace. Net sales were up, but P&G dropped prices by 2% in the first quarter. CEO David Taylor acknowledging that changes are needed, saying, We have large businesses in several difficult markets. The ecosystems in which we operate around the world are being disrupted and transformed.
I think P&G, like a lot of big CPG companies, is finding consumers are less loyal in a post-mobile phone, post-Amazon world. It's not that they like the brands less, it's just that they have more options.
Amazon is making lower-priced household staples a staple of consumer shopping patterns. Also, discount retailers like Aldi are helping keep prices down at supermarkets. Hoping to find growth, P&G also announced it plans to acquire Merck's consumer health business at a cost of more than $4 billion. Margins on Merck's vitamins and nasal decongestants are good, but total sales amount to roughly $1 billion. And analysts wonder just how much impact it will have on P&G, a company that does about $66 billion in sales each year.
It's going to have a minimal effect. It's a smart direction for them to go. We know they've had some success. We know they continue to have success in OTC with Vicks and some of their other brands. I like that they're going in that direction. No, I don't think it's very material.
P&G's guidance is unchanged, with sales growth expected at 2 to 3% this year, and expectations that it may fall in the low end of that range. Bill?
So there you have it. Semiconductors and consumer staples pulled this market lower today. In fact, at one point, the Dow was down almost 200 points. But losses were paired late in the session on a report that Deputy Attorney General Rod Rosenstein told President Trump last week that Mr. Trump is not a target of any part of the special counsel's investigation. So by the close, the Dow was down just about 83 points, closed at 24,664. The NASDAQ was off by 57. The S&P lost 15. You know, the stock market has been stuck in a trading range for 3 months now, and traders are wondering, what's it going to take to return to those highs that we hit in January? Bob Pisani takes a look for us tonight.
Stocks lost steam today as rising rate fears started to take hold. Investors are once again focused on earnings. And earlier this week, it looked like the markets wanted to push higher. The S&P's up 6 of the last 9 trading days. Now the street's wondering if they can break the old record highs back in January. We're only 2% away from record highs in the small cap Russell 2000 and 6% away in the S&P 500. But most traders are doubtful we can get there because they fear the great rally killer, the Federal Reserve. Now, nobody thinks a recession is imminent, but Fed rate hikes are ahead of us. We seem only 1 or 2 nasty inflation reports away from rates rising again. The market is interpreting this to mean there could be 4 rate hikes instead of 3 in 2018. But we've got earnings, and they're fantastic. They're getting better and better, and the majority of companies are beating by much more than expected. There's other issues at play here. The markets for the moment seem a little overbought. Geopolitics could return. And remember, we're entering a seasonally weak time of the year. Global growth also seems to become a little more difficult. European earnings are expected to come in weak, a measly 2%. That's a strong euro. That's a problem. The bulls can only pray that the earnings keep getting better and better into the second, third, and even the fourth quarters. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
The International Monetary Fund says global growth is solid, but that rising trade tensions between the U.S. and China risk undermining the progress that's been made.
What I am concerned about is that this be debated in a multilateral setting with everybody involved, because at the end of the day, you know, enterprises, companies, corporates, they operate on a cross-border basis. They know no boundaries. They organize their supply chain on a completely multilateral basis. And so all countries have to be at the table to address those issues.
Ms. Lagarde added that unilateral tariffs are not particularly effective. So, with global growth looking solid pretty much around the world, where are some places that you should consider putting your money to work? Joe Barato joins us now to discuss some of his ideas. He's Director of Investment Strategies at Arrow Investment Advisors. Joe, good to see you. Welcome.
Thanks for having me.
So you feel as though there's increasing value overseas, even though our earnings are coming in pretty darn good, and the economy seems to be firing on all cylinders.
Yeah, well, look, there are 3 factors why. Look at last year. The U.S. equity market was up about 24%, and you had 31 markets that 31 country markets that outperformed the U.S. equity market. So there's been a movement overseas, and we see 3 reasons why that is. You see the dollar on decline, you see inflation on the rise, and you see the spreads between U.S. equity, and the commodity markets at this all-time low that we haven't seen since the dot-com bubble. And that all is a recipe for what could be very well in favor for companies that have exposure overseas.
So you have some ETFs here that invest overseas that you want to tell us about. I can't remember the last time somebody recommended Finland, but you've got an ETF that invests in Finland. Why there?
Yeah. Well, you know, we have ways of kind of getting exposure to the international markets. We think first and foremost that investors should be thinking about things that are not correlated to the U.S. equity markets. So there's a lot of exposure to the developed markets through the IFA. IFA is a broad market index. But we like getting exposure down at that granular level, at the country level. Finland was very strong last year, and Finland is continuing that strength going into this year. The same could be said for Qatar. Qatar was down dramatically last year for a lot.
Let's go to your next, which is the Guggenheim Frontier.
Sure.
Frontier, obviously indicating that it is maybe perhaps some of the smaller markets around the world. Why do you like it?
Well, we like the frontier markets because, first of all, it's a package solution. So you're right. Finland, trying to buy an individual country, you really have to have, you have to understand how to do that. And with a package solution like this, it's going to give you those countries in a balanced portfolio. And there's, 4 countries that are inside the frontier markets today. And again, that's just another way for investors to play, getting exposure to something that would be maybe very difficult to do on an individual basis level.
Absolutely. Thanks, Joe. Appreciate it. Joe Baratta with Arrow Investment Advisors.
Meantime, Main Street is also paying close attention to how the latest trade tit-for-tat plays out. Kate Rogers reports now on small business owners who feel caught in the middle of the 2 economic superpowers.
For Alice Reed, potential tariffs on exported goods to China could be make or break for her business. Off the grid, Reed's Green Growers in Lincoln, Nebraska has been in her family more than 100 years, growing corn and soybeans. Retaliatory Chinese tariffs on exported soybeans have her on edge at a time when she says the agricultural economy is already suffering.
We're pretty afraid of hearing about these tariffs.
Reed says she supported Hillary Clinton in the election, concerned about what President Trump's policies might mean for Main Street.
We're small business. We stand for American ways, and we sure hope that he would help out the small guy instead of harming us. We're hurting down here. The Nebraska economy is dependent upon farms, and that's our business. We hope that he can come through and help us.
Others say a possible trade war is making planning ahead more difficult. Jason Duff, owner of Bell Fountain, Ohio Properties, invests in and renovates small businesses in town. He says potential steel and aluminum tariffs have led to price increases from vendors.
Right now, as there is greater uncertainty in the market, it's difficult for me to plan and take initiative and risk in doing future projects. We're watching every penny right now.
That being said, Duff said he supports the president's decision to try to level the playing field with our trading partners. And as an independent voter, he decided to support the president in the 2016 election.
I'm appreciative for the Trump administration taking action and steps to make this trade imbalance more fair. Even with it being a short-term setback for our companies and my business, I think the long-term approach is smart that we have this conversation now.
Advocacy groups have been equally divided on the issue. The conservative National Federation of Independent Business says tariffs don't have a big impact on its membership and point out that trade ranked last out of 75 issues polled in its latest survey. Meanwhile, the nonpartisan National Small Business Association and the Small Business and Entrepreneurship Council have been more critical of tariffs. In fact, the SBE Council just testified before Congress, urging for free trade and the strengthening, not undermining, of NAFTA. For Nightly Business Report, I'm Kate Rogers.
Speaking of NAFTA negotiators were back in Washington today, working on a deal in principle that they hope can be finalized in the coming weeks. The talks have been described by Canada's trade minister as entering an intensive phase.
Rules of origin are fiendishly complex. It's important to use this as a process that certainly enhances North American competitiveness, that is good for our steel industries, that ultimately, though, it does have to be something that works.
Some of the sticking points that remain are over the automotive and the agricultural sectors.
Time to take a look at some of today's upgrades and downgrades. We begin with Walmart. Their rating was raised to buy from hold at Argus Research. The analyst there says an improving job market should help low and middle income shoppers to spend more. The price target on Walmart raised to $100. Stock rose fractionally to $87.89. And Sprint's rating was upgraded to neutral from underperformant Macquarie. The analyst says that merger talks with T-Mobile could support the stock near term and lower the downside risk. Price target $6.25. The stock drifted lower today to $5.96.
Still ahead, fewer opioid prescriptions are being filled, but there could be some unintended consequences. There are reports tonight that regulators are planning to fine Wells Fargo about $1 billion for alleged auto and mortgage market abuses. According to the Washington Post, the fine could be announced as soon as tomorrow. It would be one of the most aggressive fines of the Trump administration.
Airline regulators have now ordered ultrasonic inspections on the fan blades, jet engines that are the same type as the one on the Southwest Air flight that made the news this week. The FAA said it will issue a directive in the next 2 weeks requiring certain fan blades to be reviewed when they reach a certain number of takeoffs and landings. Southwest, for its own part, has said that all those blades will be reviewed within the next 30 days or so.
Americans are filling fewer prescriptions for opioids. In fact, a new study shows that the number fell dramatically last year, but the crisis is far from over. Meg Terrell has the details.
Prescription painkillers like OxyContin have played a major role in the opioid crisis, and public health officials have increasingly been calling for changes in the way they're prescribed. According to a new report, those measures appear to be working. The volume of prescribed opioids in the U.S. peaked in 2011 at about 72 pills per American adult, up from 22 pills in 1992. New data today from the IQVIA Institute, an industry researcher, show that decline accelerated last year, reaching an average of 52 pills per adult in this country.
This is a significant drop. We think it's important to see that and to recognize that some of the programs, perhaps many of the programs that have been put into place in the past year or two seem to be having an impact.
Health insurers and pharmacy benefit managers have been implementing new regulations to try to limit overprescribing of opioids, such as restricting new prescriptions to just 7 days and monitoring prescribing practices more closely. They've also lifted hurdles for accessing so-called medication-assisted treatment for opioid addiction, and prescriptions for those medicines, such as buprenorphine, have been on the rise.
What we're reporting is almost doubling in the number of new patient starts using one of these medication-assisted therapies, going from about 42,000 patients a month at the beginning of 2015 up to 80,000 a month at the end of 2017. So a quite rapid increase in the use of those medication-assisted therapies.
Unfortunately, though, prescription painkillers are not the only source of the problem, and both heroin and stronger synthetic opioids like fentanyl have overtaken prescription drugs as the biggest causes of overdose deaths, according to the CDC. But overdoses from all forms of opioids were increasing through the end of 2016. And the reduction in availability of prescription opioids may have had some complicated effects, according to public health researchers.
It's generally good news that prescription opioids have declined. It's been accepted that there's been overuse. I guess unanswered question, you might say, is whether some of the policies that have been in place have led to other unintended effects, whether it's transition, and one of the main ones that people are concerned about is whether there's been a transition to heroin and other forms of opioids because of the reduction in prescription opioids. And I think that is an unanswered question and something people are looking at. That, I think, is the concern.
So still a lot of work to be done. For Nightly Business Report, I'm Meg Terrell.
Shares of Philip Morris get smoked, and that's where we begin tonight's market focus. The tobacco giant said that revenue grew at a slower than expected pace on a drop in cigarette volume. They also admitted that new smokeless tobacco products haven't resonated with customers. Philip Morris did increase, though, its full-year earnings forecast, but that was a result of new tax changes. And we saw the stock have its worst day in a decade today, falling more than 15% to 85.64. Botox maker Allergan is no longer considering a bid for drug maker Shire. Allergan had earlier confirmed that it was interested in a merger, but then revised course, citing opposition from shareholders. Shire, which focuses on rare disease treatments, had already turned down a more than $60 billion takeover offer from Japan's Takeda Pharmaceuticals. Allergan shares fell 4% to 158.59. Meanwhile, shares of Shire were off 1% to 160.74. And earnings fell at Blackstone, but the private equity firm still managed to top analyst expectations. The company also delivered a revenue beat. Blackstone said that it was adding $1 billion to its share buyback program and also said it plans to pay a 30-cent special dividend this year. Blackstone shares climbed by 1% to 32.12. Sue?
Bill, late today, Mattel announced that its CEO is leaving the toy maker to pursue other opportunities. But her departure comes after just a little bit more than a year on the job. She will be replaced by the incoming executive chairman. Shares of Mattel were off 3% to $13.45. After the bell, trading platform E-Trade reported earnings that topped street expectations. The company's results were helped by an increase in market volatility. The shares were initially lower in the extended session. They ended the regular session up about 1% to 58.83. And after the bell, Skechers reported profits and sales that came in ahead of estimates, but the sneaker maker's outlook for the current quarter disappointed investors. They sent shares down sharply in after-hours trading. The stock finished the regular day down a fraction to 42.08.
Coming up, taking the lead, the most valuable artificial intelligence startup in the world is not in Silicon Valley, but it's in China.
Artificial intelligence widely considered to be the next big thing. But the world's most valuable startup in that field is not in Silicon Valley, where you might expect it to be. Instead, it's halfway across the globe. Eunice Yoon reports tonight from Beijing.
And you know that, so we could now put...
You may not have heard of SenseTime, but the CEO of the Hong Kong startup has a message for Silicon Valley. The face of the world's leader in artificial intelligence may be changing.
I think China really has advantage.
Backed by Alibaba and Qualcomm, the 3.5-year-old facial recognition company led by Li Shu is now the most valuable AI startup in the world.
The government is encouraging different sectors and maybe different industries to using those kind of new technology. And this is very important for maybe for us, for startups.
The Chinese government wants to be a leader in AI, pledging to turn it into a $150 billion industry by 2030.
So Face as an ID should make life much easier. Walmart, all those companies, they embracing the facial recognition technologies.
Privacy issues have risen to the forefront in the U.S., not so in China, says veteran investor Kai-Fu Lee.
I think Chinese users at this point in time are more willing to trade privacy for convenience. So that, I think, will help the companies build up more AI applications.
SenseTime Shu believes eventually people will become more comfortable having their movements tracked. But until then, the privacy debate may hold back U.S. tech companies from competing.
Currently, I think it will hold back. So, but maybe it takes time. I think the U.S. or even the world can see that it is no harm to use those kind of technology.
For Nightly Business Report, I'm Eunice Yoon in Beijing.
The hedge fund industry has largely underperformed the broader market during this current bull run, and there have been any number of reasons why, from a lack of market volatility to a trend toward passive investing. But now researchers may have found another reason why. Brace yourself. Leslie Picker has our story from Orlando.
Hedge funds, an industry synonymous with alpha. That's what most of them strive for. alpha or outperformance. But it's also an industry spearheaded by a certain stereotype. Straight out of central casting, the alpha males. A new study asks, do alpha males, or those with higher testosterone levels, deliver better returns?
Research conducted here at the University of Central Florida and Singapore Management University found that hedge fund managers with higher testosterone levels tend to underperform those with lower testosterone levels by 5.8% each year on average.
The distance between them. Researcher Yan Liu used hedge fund managers' facial dimensions as a proxy for their testosterone levels. She studied images of over 3,000 hedge fund managers, all male. She used this square tool to measure the facial ratio to determine their testosterone levels. Liu's report cites other studies showing the facial width to height ratio as a reliable cue to masculine behaviors. Liu also found that high T levels in a firm's figurehead made it more likely the fund would close.
We found like the high level of testosterone can, for human beings, can bring to the aggression, fearlessness, risk-taking, and all egocentrism. And then these features can also lead to the unethical behavior.
Other studies have found that testosterone has been beneficial in certain jobs, namely for CEOs and high-frequency traders. But for better returns in the hedge fund world, Liu advises investors to avoid alpha male managers. For Nightly Business Report, I'm Leslie Picker, Orlando.
Okay. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. See you tomorrow.